The next thing we're going to deal with then is tying some numbers into this equation and seeing how the math behind this will work. So, let's say we go through all these calculations and we come to some numbers. We end up with some math we can work with here. Let's say that the need for life insurance, the need that arises in the immediate period is, let's say, $300,000 to pay off the mortgage, to cover off the cost of the funeral, all this money that we have to come up with right away on that person's death. Let's say that, in total, all the cash that we have available, or that we will have available quickly after this person's death, let's say this totals up to $100,000. Now, I think we can see a problem here. They need $300,000. They have only $100,000. We'll come back to that problem momentarily. Let's go to the ongoing side of the equation. So we add up all the costs here that are going to arise, and I've only put a small sampling up here. Anybody who's dealt with the costs of raising a family will know that this is by far not a thorough list. But let's say that we figure out that each year this family will need $60,000 in order to deal with all of this stuff. And let's say that we figure that the surviving spouse might go back to work in some capacity upon the death of their spouse. They're going to have CPP, survivor's pension, maybe some income from investments or some other source. And let's say that we calculate out that in total they're going to have $40,000 in annual income, $40,000 per annum or $40,000 per year to deal with these ongoing needs. Now, again, we can see a problem here. Let's have a look at our problems. First off, let's have a look at this problem over here. We can clearly see that they need $300,000. They have only $100,000. So, they have a $200,000 shortfall, which we will, of course, address using life insurance. That is, we recognize now that in order to put the proper amount of insurance in place, this family is going to need at least $200,000. Now, that $200,000 is not going to be enough. That's only enough to address this immediate period. Essentially, we could look at it like this, that when this person, when our life insured, passes on, this $200,000 is gone that instant. So it helps them to deal with this premature death, but it's not all that they need to deal with this premature death. We can now go to this side of the equation. We say, okay, what's the problem here? Well, we have a shortfall here of $20,000 per annum. So in order to do anything with that $20,000, here's what we're going to look at. How could I generate $20,000 a year for this family? So I'm their insurance agent. I recognize that they're going to have a $20,000 a year problem. What I might think here is, why don't we take a lump sum of money, invest that lump sum, and use the investment earnings off of that invested lump sum to help generate the $20,000 a year that they will need. That's going to work in most cases. So, in order to carry out that equation, the next thing that I'm going to have to do is to figure out how much money I have to invest each year, how much money I have to invest in order to generate that $20,000 each year. And here's how I might do that. I'm going to assume an interest rate, and it doesn't really matter for our purposes here We'll talk more about making realistic projections around interest rates a little bit later on. What we don't want to do is we don't want to project something that would be inordinately high here. It's going to be impossible for them to meet those expectations. Let's assume that we can make a 4% rate of return on any investments that we make upon the death of our life insured. So if we use an interest rate of 4%, the way to figure out the lump sum that I would need to generate $20,000 a year, I take that $20,000 need. And now it's time to pull out our calculators. We say $20,000 divided by 4%. And using our simple calculator, you could type it into the calculator exactly like so. 20,000 divided by 4%. I'm going to get a need of $500,000. And basically, what's happening here is we take that $500,000, we invest it, as we've indicated, at a rate of 4%, and that's going to generate $20,000. It will generate that $20,000 every year, every annum. So they have now the $20,000 they need. Essentially what's going to happen here, this family will invest this $500,000 that they will receive as part of the life insurance death benefits when we put the proper amount of insurance in place for these folks. And now they have $500,000 invested, earning 4%. That'll generate $20,000. They'll take that $20,000. They'll use it to meet these needs that arise. The $500,000 will remain untouched. Again, next year, the $500,000 will be invested at 4%, generating the $20,000 that they will use to meet these expenses. And they'll go through that cycle year after year after year after year. The idea being the $500,000 will never run out. They will always have the $20,000 that they need to meet those expenses. So in total then, how much insurance do they need? Well, we can see that they need $500,000 to take care of their ongoing needs, plus $200,000 to take care of their immediate needs. The total need for insurance then will be $700,000. That is, based on this needs analysis for this family, we figure out that they need $700,000 worth of life insurance. There are several questions on the exams that deal with this situation that expect you to recognize how much insurance a family needs. I'm going to reiterate again that I suggest you start off by simply drawing this table, and then as you read through the exam question, you can draw the information out and put it on the table. At the end, it becomes some fairly straightforward math, which is not that much of a challenge once you've laid the information out properly. Once you're out in the industry, you're going to find yourself doing exactly the same thing. Thank you again for joining me for this series of the LLQP video presentation.